Hi students, welcome to Sunil's tutorial. I am Sunil Mirwani and today we will be doing this chapter called as capital budgeting. Today I am going to explain to you a different concept like how assets are subject to depreciation. Similarly, money is also subject to depreciation. If you see a product, if you buy for 100 rupees in the current year, in the subsequent year you have to pay 110 rupees for it. In the subsequent year you may have to pay more money for it. So as time passes, to buy that same quantity you have to pay more money, which shows that the value of money is going down. Now how much is the value of money going down? Ideally the value of money goes down, the value of money goes down to the extent of the interest rate. Whatever is the fixed deposit interest rate given to you, that is the extent to which the value of money goes down. That means if I want to buy, say this is my current year, second year and third year. If I want to buy a product for 100 rupees after 1 year, right, money must have depreciated. That means its value today should be less. Say let's assume today it's available for 91 rupees. Then this is called as present value of future money. That means present value of 100 rupees after 1 year is 91 rupees. Similarly, let us assume that if I want to buy a product for 112 rupees after 2 years, today if that product is for say 88 rupees, then 88 rupees will be the present value. So do we understand what is present value and why is there a difference between the present value? Because money gets depreciated. As the value of money goes on going down, the product will be available for a cheaper rate in the current period than in the future period. Now in business, you are going to earn profit in the future period after 1, 2, 3 and 4, 3, 4 and 5 years. So what will be, suppose if I am earning a profit of 10,000 after 2 years, what is its equivalent profit in the present year? That is what we have to find out, right? Let's try to see this with the help of a sum. Let's see illustration 13, page 289, right? They've given you that Gati Company Limited is considering the 3 investment proposals requiring net cash outlay of 1,20,000, 1,70,000 and 2,40,000. The after cash inflows are tabulated. Rank the following, right? They have given you year 1, 2, 3, 4 and 5. PV factor at the rate, present value factor at the rate of 15%. How do I know it is 15%? It is given to me in the sum. That assume that the firm's cost of capital is 15%. Now if you open your book, at the end of the book there is something called as table A. In table A you will see there are percentages given along x-axis. There you have to see 15%. See 15% and see its value from 1 to 5 years. When you see those values, you will get the values as 0.870, 0.756, 0.658, 0.572 and 0.497. These are the present values of 15%, right? Now let's first see project X. Project X, project Y and project Z, right? Cash inflow. Right? The cash inflow of project X is 10,000, 30,000, 45,000, 65,000 and 45,000. Similarly, the cash inflow of project Y is 50,000, 65,000, 85,000, 50,000 and 35,000. The cash inflow of project Z is given to you as 90,000, 1,20,000, 70,000, 50,000 and 20,000. Once I have the cash inflow, then how do you find out the present value? Guys, present value is given by the formula cash inflow into present value is given by the formula cash inflow into present value factor, PVF. So in the first case, it will be 10,000 into 0.870. That means that will be 8,700. The second one will be 30,000 into 0.756, which is 22,680. Next is 45,000 into 0.658, which will be 29,610. Similarly, you will have 0.572 into 65,000, that is 37,180. And finally 45,000 into 0.497, which is going to be nothing but 22,365. Add this. When you add this, you will get total present value. If you add all of this, your total present value will be 1,20,535. Right? The addition of all the PV is going to be this. What was your original investment minus investment? Your original investment for project X was 1,20,000. Therefore, your net present value is 535. Right? That means the net money that you will earn from this project at the end of 5 years, if you were to get all the money today, is 535 rupees. Remember one thing, students, if the value of NPV comes out as negative, you have to reject the project. Now similarly, let us try to work out for project Y. Let's find out the PV, present value for project Y. Same way, cash inflow into present value factor. So 50,000 into 0.870 is going to be nothing but 43,500. Then 65,000 into 0.756 is 49,140. 85,000 into 0.658 is 55,930. 50,000 into 0.572 is 28,600. 35,000 into 0.497 is going to be 17,395. Again, when you add all this will come to 1,94,565. For your project Y, your original investment was 1,70,000. So your net PV 70, 80, 90, 24,565. Right? Same way, let's work with project Z. Cash inflow is given, you have to find out present value. Present value is nothing but cash inflow into present value factor. So it is going to be 90,000 into 0.870, which is 78,300. 1,20,000 into 0.756, which is 90,720. Then 70,000 into 0.658, which is 46,060. Then 50,000 into 0.572 is 28,600. And finally 20,000 into 0.497 is 9940. Add the whole thing. When you add the whole thing, you will get 2,53,620. 2,53,620. Your original investment in this case is 2,40,000. So this is going to be 13,620. Now, when we look at all the three projects, my maximum net present value is in project Y. So if I have to rank these projects, the first rank would be given to project Y because it has maximum NPV. Second rank would be given to project Z and the final would be to project X. Fine, do we get this? Let's try out one more sum, guys. Let's see one more sum. Let's do illustration 14, page 290. They've given you data regarding two projects. They've given you that years 1, 2, 3, 4, 5. Right? They've given you project. First, let's see the present value factor. They've given you that the net present value using 11% discount rate. 11% discount rate, that means I have to find out present value at the rate of 11%. Right? Now, all you have to do is look at table A, look at 11%, open table A at the end of the book, look at 11% and see the first 5 figures there. Now, when you read the first 5 figures, 11% is not given to you in the table, so you will have to consider at the rate of 10%. Since 11% is not given to you in that table, you will have to consider at the rate of 10%. So at the rate of 10%, the figures are going to be 0.901, 0.812, 0.731, 0.659 and 0.593. These are my present value factors at the rate of 11%. Now let's see the two projects. The first project is Tata Limited. Name of the first project is Tata. And the other project, let's write its cash inflow and present value. And the other project is Bata. Cash inflow and present value. Now, the cash inflow is given to you as 50,000, 80,000, 1 lakh, 80,000 and 60,000. Right? Same way for Bata, the figures are 80, 60, 80, 80,000, 60,000, 80,000. Then you have 60,000 and 80,000. These are your cash inflows for 5 years. Very simple, guys. Cash inflow multiplied by present value factor. So when you multiply cash inflow by present value factor, you will get 50,000 into 0.901 is 45,050. Similarly, 80,000 into 0.812 is going to be 64,960. 1 lakh into 0.731 is 73,100. 80,000 into 0.659 is 52,720. 60,000 into 0.593 is 35,580. So when you add this, this is your total PV. Your total present value over a period of 5 years is going to be 2,71,410, right? Less investment. The original investment for the first project is 2 lakhs. So your net present value is nothing but 71,410 for the first project. Let's see the second project. In the second project, 80,000 into 0.901 is 72,080. 60,000 into 0.812 is 48,720. 80,000 into 0.731 is 58,480. 60,000 into 0.659 is 39,540 and 80,000 into 0.593 is 47,440. Add this. When you add this, you will get your total PV, which is 2,66,260. The original investment in the case of Bata is 2,10,000. So your net PV is 56,260. Since the net PV is higher for Tata Limited, therefore Tata Limited project will be selected, right? Okay, let's see another sum of this kind, guys. Let's see. Question number 18, page 295. Question number 18, page 295. Now, they have given you the cash inflow of two projects and they have asked you to find out the PV, right? So let's see this. Years 1, 2, 3, 4, 5. They have given you that, if you see the last paragraph just before the table, they have given you cost of capital is 10%. So that means you will have to find out PV factor at the rate of 10%. Open your end of the book. There is a table A. In table A, look at 10%. See the first 5 figures. The first 5 figures are 10%. First 5 figures are 0.90. Instead of taking 3 decimals for this particular sum, you do it 3 decimals. I do the calculation with 2 decimals. I'm approximating it, guys. There's no need for you to approximate. I'm approximating it. Instead of doing 3 decimals, I'm doing it with 2 decimals. 0.91, 0.83, 0.75, 0.68 and 0.62. Right? So these are your PV factors. Either they will be given to you in the sum or they will give you that chart. In the chart, you have to look at table A. You have to look at 10% the first 5 figures. Right? Now, let's consider project X. Cash inflow, present value. Project Y. Cash inflow, present value. Right? Let's see the cash inflow, guys. Just a minute. Okay, the cash inflows. The cash inflow for project X is given to you as 35,000, 80,000, 90,000, 75,000 and 20,000. These are the cash inflows given to you. Similarly, for project Y, the cash inflows are given to you as 1,18,000, 60,000, 40,000, 14,000 and 13,000. Okay. Now, very simple, guys. Cash inflow multiplied by present value factor. All you have to do, multiply. So 35,000 into 0.91 is 31,850. Then 80,000 into 0.83 is 66,400. 90,000 into 0.75 is 67,500. 75,000 into 0.68 is 51,000. 20,000 into 0.62 is 12,400. Add this is total PV. When you add the whole thing, you will get this as 2,29,150 less investment investment for project X is given to you as 2 lakhs. So your net PV is 29,150. Now same way I can work for project Y. Cash inflow multiplied by the present value factor. That means 1,18,000 multiplied by 0.91 is 1,07,380. Then 60,000 multiplied by 0.83 is 49,800. 40,000 multiplied by 0.75 is 30,000. 14,000 multiplied by 0.68 is 9,520. And 13,000 multiplied by 0.62 is 8060. Add this, so you will get your total PV as 2,04,760. 2,04,760. The original cost of the project is 2 lakhs. So 4,760. The net PV is 4,760. Since the net PV is greater for project X, therefore project X will be selected. Guys, in this sum they could have asked you another thing. They could ask you profitability index. If they ask you profitability index is nothing but total PV upon investment. Total present value divided by investment. Right? In the case of project X, it will be 2,29,150 divided by 2 lakhs. So when you divide this, you will get this answer as 1.146. Right? Whereas in the case of project Y, it will be 2,04,760 divided by 2 lakhs. The answer for which should be 1.024. Since the net PV and the profitability index of project X is greater, hence project X will be selected. This finishes this. We will stop here for the day. Thank you very much.